Good evening, everyone. I'm Andre Obieres, returning anchor, welcoming everyone to the start of the second episode of Season 4 of our RFC Tuesday podcast. Together with me this episode is our mainstay, Kuya Ryan Daez, and our very special guest for tonight. So, anyway, as I said earlier, this is Season 4, creating a resilient investment portfolio. That is our theme for the season. And Episode 2, practicing portfolio management. Tonight, we have an extra special guest. He is a portfolio manager and the author of the book, Portfolio Management for Private Wealth, An Introduction to Theory and Practice. I actually have a copy of his book right here in my office. I actually read it from time to time. It's also one of my favorite books on the topic because it's not thick, right? But it's very deep. You learn so much, and because I think this is very essential for all of us financial consultants, to improve our practice, actually applying portfolio management theory, because this will help us achieve this will help our clients achieve their dreams.
This show is powered by IARFC Philippines, the Philippine chapter of the International Association of Registered Financial Consultants. The IARFC-PH is an association dedicated to the craft of financial consulting. The association is the sole organization authorized to conduct the RFC conversion courses, as well as continuing education in the field of financial consulting.
We are your hosts tonight. I'm Andre Michael Obieres, a registered financial consultant and an equity portfolio manager.
And I am Kuya Ryan Daez, a registered financial consultant, a chartered wealth manager, and a registered estate planner. I would just like to remind all of you to fill in your questions for the next episode so that we can talk about it, since all of our episodes are pre-recorded, and the next sessions would be in the second and fourth week of each month. So, by the way, we would like to acknowledge the talent behind the video magic of our episode for tonight, done by our official video editor, Mr. Bong Escobar. For those in need of professional video editing services, you may get in touch with him to 0933-814-0272 or via bongescobar2000@gmail.com. By the way, Andre, let's greet our regular participants and viewers on this podcast. Hi, especially the board. Thank you for continuing to support us.
Good to see you, everyone.
See you again. So please do stay tuned tonight because we have a very exciting guest for tonight. So thank you for being with us. So if you wish to view the previous episodes and share them with your RFC or even non-RFC colleagues, it's okay because we want to spread the news about how we do things here. You may find them in the IARFC-PH Facebook page. So that's where you're watching us right now. So, Andre, are you very excited for tonight's episode?
Oh, for sure. I'm actually really excited to talk about portfolio management. This is what I do for a living.
Yeah.
So, anyway,
Same with me.
Yeah.
Same with me. And while we were talking with our guest a while ago, I'm already excited. Actually, I'm very much excited for what we will be tackling tonight. So, Andre, would you introduce our guest?
All right. So tonight's guest is Mr. Jesse Picunco, CFA. Jesse has been involved in investment analysis and portfolio management for most of his career. He began his career at Decision Economics in New York, analyzing economic data and writing research briefs for a hedge fund and trading floor client base. After business school at Vanderbilt University, he worked at the Tennessee State Employee Pension System, managing a number of fixed income portfolios, including mortgage-backed securities and TIPS. He then began working at Merrill Lynch as an analyst for a local team and then RVW Wealth, bringing his institutional experience into the private wealth setting. His observations led to the writing of his book, Portfolio Management for Private Wealth. Jesse, I just actually introduced you, so everyone, well, please welcome our guest for tonight. And I actually really want to know more about your story. Aside from
Yeah,
that short clip. So could you
absolutely.
please tell us how you actually stumbled into portfolio management?
Sure. I've always been interested in the financial markets, and my first job out of college was at Decision Economics, which was wonderful because every day we were embedded in the daily flow of economics. At the end of the day, all our clients cared about, well, what was going to happen to the 10-year, the 10-year treasury rate. But being embedded, seeing how we responded to economic data, how the market responded to economic data, and seeing which indicators were important really got into the pulse of what was going on. And I love that aspect of it. But it's at some point, just looking at data and not making any of your own decisions gets a little boring. So I went to business school and was lucky enough to land with the Tennessee State Employee Retirement System, which at that time was about $35 billion fund. I was in a fixed income division, which is very quantitative in how portfolios are managed. And I was also lucky enough to be sitting in a mortgage-backed security seat right before the financial crisis. So it was so interesting to see how theory was such a big part of what happens in the fixed income world. I mean, every fixed income trader has a Fabozzi book by his side. So the theory is so much a part of it. But then we had tools all day long. We could have Yieldbook or BlackRock Aladdin or Barclays Point, all these different tools that helped us analyze our portfolio. So it dawned on me eventually that we have the theory, which is so integral to our understanding of the product, but then we have these resources that institutional investors have, and they take it for granted, what I realized later, because all day long, your job is to generate alpha. That's all you're paid to do. Nobody cares how nice you are or how well you get on with your colleagues. How much alpha did you generate? That's the conversation. And every day we're talking to each other about how we're managing our portfolio, how we're thinking about it. And then in our own particular specialties, mine being mortgage-backed securities, you learn a lot by making mistakes. You learn why, when you're looking at your portfolio, you're saying, why do I have that bond? Why did I buy it? Why do I still have it? And the way it responded and the way you've been tracking your portfolio and the way you've been preparing the portfolio is an everyday thing. And it was truly educational every day, and it was amazing. After I was there for about 8 years, and then got married and left town and wound up at Merrill Lynch. And here I went from this, it was a avalanche of information, but there was order to it. We knew how to say, this is what we needed to do what we wanted to do. On the retail side, I realized there's an avalanche of information, but there's no way to sort it. There's no way to put it together into a theme, into saying, this is what we're trying to do. And I was frustrated when I'm talking about theory or talking about portfolio construction, very simple techniques. The people around me weren't familiar with them. And I was also frustrated by the kill or be killed, competitive, every man for himself attitude, where no one really wanted to learn from each other. There were walls around every advisor. They did their thing. And there wasn't that camaraderie. And I missed that. And after a year, I began to be so frustrated by seeing that they weren't taking the easy steps to manage their portfolio, that out of rage, I began to write my book. And it was basically from a conversation about beta. The advisor I worked with laughed at me when I talked about the portfolio's beta. And he had one mutual fund that had a beta. It was an equity mutual fund mostly, but it had a beta of 0.65. And to explain why that was so wrong for his clients really took a book, because it bridges both the theory of what we're trying to do and the practice of what we're trying to do. And when you look at a lot of portfolio management textbooks, like here's 1,000 pages of theory, and then we'll talk about options and we'll talk about futures, and then it's sort of, there it is. But the practical side of building a portfolio is missing. I just looked at a syllabus for a portfolio management class, and I went through all the bullet points, and I said, none of that is portfolio management. And so that's why I wrote the book, to say, to bridge theory and not worship in front of it, but say, this is the advice it gives us. These are the guardrails around what you can do and what you should do. And so a lot of my book is about how we can create portfolios that are controlled so that the risks we take are determined, they're on purpose, and we don't or minimize the accidental mistakes.
That's pretty interesting stuff, and I can really relate to what you said earlier about working in the sell side, where every advisor is for himself, right? Working in silos, and many of them actually don't have a good grasp of portfolio management theory, that they actually don't even know these details. It's actually when you actually go there in the trenches, it's an eye opener. Right. And when these when advisors are talking to their clients, the clients often think, oh, these guys really know their stuff. Right.
Well, it's unfortunate. And I feel the biggest unfortunate aspect is the lack of communication, because we all like this stuff. We're all here and we should be best friends because we're all liking the same thing.
Yeah.
But nobody is on the same side. And I know we're competitors. We're fighting for the same dollar from a client. But we can still learn from each other and respect each other. And I feel like there's just that division, that wall around us that doesn't need to be there.
Yeah, I totally agree.
Very true.
So anyway, let's move on to our
Sure.
show.
Yep.
I think it was a particularly interesting point when we were talking about the sell side and the portfolio management, right? So when we talk about this, or we always hear that portfolio management and wealth management being interchanged. Could you tell us what is the difference between the two?
Sure. So wealth management is an extremely important role. It helps the client manage their financial affairs so that they don't have to worry about anything, whether it's insurance, it's trusts, estate planning, wills, whether to buy a home, what their distribution rates can be. Those are very crucial things. But also being able to get a client to trust you and give you all their information, it's a different skill. Now, I'm not sure about you, but we have an image of analysts sitting at their desks and behind their Excel spreadsheets and their Bloomberg monitors. They don't seem like the approachable type. They don't seem like the type to go out and say, hi, tell me everything about yourself. I'm really interested and I want to know. It's a different job. It's a different mentality. It's a different skill set. A portfolio management practice is understanding what is available in the market, what makes sense to invest in, where the market has been, and what is efficient when I put it all together. A lot of investors, advisors seem to think if I buy 10 or 15 mutual funds or ETFs or stocks or 30, 40 stocks, I've got a portfolio or bonds. A portfolio is, I bought it, so it's a portfolio. I don't think that's what a portfolio should be defined as a bunch of stocks and bonds. I think a portfolio should be defined as a collection of compensated risks, because what we are most concerned about as portfolio managers is choosing which risks we want to take, how much of that risk, and whether we are adequately compensated for that, and where I can get the best compensation for that risk. And so that's why I think that we should separate them in our heads. Because if we think I'm a wealth manager and by default I'm a portfolio manager, I don't think we'll have the mentality to say, I've got to separate my time. Because a wealth manager is never bored. They've got so many things going on. They need to have the separate head or a separate person who is there looking at their opportunity set, who is saying, we have our clients in the best position. So that's the difference.
So those are very interesting points. And I guess that's very true, Jesse, what you have shared. But well, here in a third world country, we do things very differently. But since it would seem that we're just starting out, what do you think are the typical problems and confusions that a financial advisor would face in creating or designing an investment portfolio for clients? And what do you think what are also the common misconceptions in portfolio management?
I think the biggest problem is assuming that I can just buy 10 or 15 funds. I'm going to say 10% to this and 15% to that and 10% to that. And I've done what I've promised that I was going to deliver to the clients. And in fact, it really makes a difference that you pay attention to what the risks are. For example, there's an advisor I worked with who loved dividend stocks and he loved healthcare, the healthcare sector. And he had a very large weight to a dividend fund and he had a separate healthcare fund. But what he didn't realize was that the healthcare fund was so underweight healthcare that his total portfolio was underweight with respect to his benchmark to healthcare. So you can go out and buy stuff, but that doesn't mean you're really doing what you think you're doing. Another example is the new innovative technology. Innovative technology did extremely well in 2020, and it did very horribly in 2021. But the interesting thing is that in 2021, the technology sector in the S&P 500 was up about 25%. Innovative technology was down between -10 and -20%. So you may think that you have one risk and you don't. So when you're building portfolios, it's not enough to just buy stuff and move on. You really have to know not what stocks you have, but broadly speaking, what risks you have.
Very nice. So it's really about the risk that the client is taking in with our recommendations. So for a new financial advisor or even existing financial advisors here, how should we start constructing a portfolio for our clients?
There is one space where wealth management and portfolio management are the same thing, and that's in the financial plan. I can't overemphasize how important the financial plan is for you and your clients, both in terms of management and communication. With a financial plan, you're able to discuss what your clients' risk tolerance is, what their liquidity needs are, how much income they might need, what their spending plans are, what the probability of success is in terms of being able to have a retirement lifestyle that they're expecting. We need every piece of the financial plan to say, this is the amount of risk that should be taken by that client. It could be that they have tremendous resources and they don't need to take risk. And so there's no reason to give them more risk than they need. Or there's other clients who might be 35, 40 years old, and they need to have a high equity allocation to generate the future lifestyle spending that they want. But we need the financial plan to have this information. And also, the financial plan is our communication, because when the market falls, if the market's falling 20 or 25%, hopefully we have realized that the financial plan is robust enough to weather a 3 to 4 year downturn. If a client can't face a 3 to 4% year downturn with a 25% drawdown in the market, then the financial plan's too aggressive. Once you have a financial plan that is safe, that is robust, then when the market does fall, you can go to the client and say, this is part of the plan. We know we can handle this, and we know that given time, the market will recover and you will be able to have the lifestyle that we talked about. Without the financial plan, there are two problems. One is that you don't really know. You're just kind of thumb in the air trying to figure out how much risks you should have. And that's not good. But also the client isn't sure about what you're doing. If you don't have the plan, then when the market does fall, you're going to feel like you have to sell. You're going to have to say, I need to protect my client. The client can't face any more of a downturn than this. And you're going to sell at the absolute worst point, and the market's going to recover, and your client's going to be left behind because you didn't have the plan in place. That is the first step, and it's the same for wealth management and portfolio management. So the financial plan has now told us this is how much risk the client can accept. Now I'm going to segue into theory really quick, and I think the gods of finance will frown on me for making portfolio theory 4 bullet points, actually 5 bullet points, but that's all I need to talk about. First,
Okay.
in modern portfolio theory, we equate volatility and risk. I think this is mostly appropriate because volatility implies we don't know how to value something. If it's very volatile, it means that it could be worth this, it could be worth that. We just don't know. And when we don't know, it's risky. You know, we have an idea of a growth rate for Coke and Pepsi, but we don't have a idea for the growth rate of a small cap stock. So they're going to be more volatile. So volatility is acceptable to me as a proxy for risk. I think it doesn't pick up fraud. A company might look great, but it might be completely fraudulent. And that's not really picked up in portfolio theory except the fact that when you diversify, you don't have to worry about one company's risk for the overall portfolio because it is diversified. The second bullet point for modern portfolio theory is that we have a goal of maximizing return for a given amount of volatility or minimizing volatility for a target amount of return. This is very important because it puts our expectations versus the expectations for good versus the cost, and the cost is the volatility. So now we can build portfolios, we can build thousands of portfolios and place them in terms of their risk versus their expected return of the entire portfolio. When we look at any given level of volatility, there is one portfolio that is ideal for any given level of risk. When we plot out that curve, and it generally is a curve because the more, as you get higher and higher risk, generally the volatility goes up faster and faster. So you get a curve when you plot out all of these different portfolios. And the best portfolio for any given level of risk will make a curve called the efficient frontier. Now, the efficient frontier is very theoretical. It is, you can plot it out, or you can adjust your expectations of expected return. But what we want to draw from this is just conceptually, there is a great place to invest for every level of volatility. Now, one more introduction to this efficient frontier is that we have a choice of a risk-free asset. And this risk-free asset gives you a return with zero volatility. So we now have a choice of being in a risk-free asset and picking one point on the efficient frontier that has the highest level of risk relative, the highest level of return relative to risk. And this is called the capital market line. But from this expression, we can now say, I've got one portfolio of risk, and then I can control exactly how much safety I want by including the risk-free asset. There are two conclusions we can draw from this. One is that assuming we have a market that has no frictions and it is easy to trade and there are no tax consequences, and every investor has a view of the market, completely theoretical, but let's just accept it for a second. The efficient frontier, the market portfolio will be the market we see. The indexes we see, the broad market weighted indexes, is the efficient frontier, the efficient portfolio. The second conclusion we can draw from that is that every client should be in that one portfolio as their risk portfolio. And then we adjust each individual client's tolerance for risk with the risk-free rate, with the allocation to the risk-free rate. So this puts guardrails around what we should be doing. Instead of saying, well, this client likes this sector and this client should have this risk. Every client should have the same risk bucket according to this approach. And it's a lot easier to manage portfolios this way, because one, if you change your mind, I've got 10% in this risk, this ETF, I can just change it across all portfolios. I don't have to look at every single client and say, well, they had this much of it, they had this much, this client didn't have it. I've got one portfolio I can change, which that can go across each client. So it makes it much easier to manage your clients' portfolios. Now, this is theoretical, and I don't want to say that we're worshiping what theory says, but as a starting place, it makes sense that we should start with what we view as a benchmark portfolio. The indexes that are broadly based are the best approach for that. This is art. There's no right one index that is appropriate. I think that this is where the advisor is allowed to say, this is how I view the world. This is what I think we should be the starting place. And unless we feel that the indexes are perfect, we're not done yet. Mm-hmm. We have to look, if we believe that indexes are good enough, there's nothing we should be doing except passive indexing for our clients, but we don't. Most people don't. So at this point we say, what don't I like about the index? I'm looking at it, and it's not the fact that it's got too much Microsoft or it's got too much of any individual stock or bond. It is much more straightforward to say, this is the risk I want more of. This is a risk I want less of. And by risk, I am talking about company size, sectors or industries within sectors, or factors like quality and momentum. Whatever you can measure in your portfolio against the index, that is what the risk that you should be embracing. And if you don't have an opinion, don't take that risk. So for example, if you wanted to be overweight technology, it's not enough to just buy technology funds. What you want to be aware of is where your allocation is with respect to the index, because we are accepting it is a guardrail. It helps you think about what you want to be doing. If you just accept that the market weight that you see in the world is a good starting place. Now, once you've decided what levers, so I want to use this word deliberately, when you're looking at your risk and deciding how you are going to be manipulating your portfolio, institutional investors use the word lever. And it makes sense because we can use the lever to say, this is where I want to go in the portfolio. And this is where I want to be underweight. This is where I want to be overweight. And you control them explicitly. So instead of buying a bunch of funds and seeing what happens, you can say, I've got this 10% exposure to 10% overweight to this lever. And then when you want to change that, you have a language and a tool and hopefully a fund that you can say, I'm going to get out of this and into that. This way, you are controlling exactly what you want. You have the weighting that you want, and hopefully you're not making an accidental misweight. So when I'm talking about this, I'm not telling you this is a way to generate alpha. I'm not saying this is technology is a great place to be. It's cheap, or that's not what this is about. This is about being in control. One thing that follows from this is that when you know the volatility of a particular lever that you're trying to express, it is easy to figure out how big that trade should be. For example, if you are afraid, let me step back. A lot of times when you buy something, let's say we're in finance, we think we're great. You're not thinking about how much the risk is. You're saying, this is such a great trade. I'm going to make a lot of money for my clients on this. I don't want to temper enthusiasm and hope, but hope is not a hedge. When you're putting on a trade, I think it is more helpful to think about how much you are willing to lose on that trade. So for example, if one idea is, if you are afraid of losing more than 1% versus your benchmark on one idea, you should know how much volatility is in that idea. So for example, let's just say tech stocks have outperformed by 25% versus the rest of the index. That means it has a good chance of underperforming by 25%. I'm not saying it would, but there's the possibility of that. Well, if you're only willing to lose 1%, then the appropriate weight for that trade is 4%, because 25% times 4% is 1%. If something is more market oriented, down the middle, let's say industrials, they have much less volatility with respect to the index, then you can have a higher allocation to that trade because it is not as likely that you're going to lose money on it. So instead of just saying, hey, I want overweight of 10% to technology and overweight of 10% to materials and underweight, have weights of 10% to everything relative to the index, that's not, you do not have the same risk on each of those trades. So, and it's fine to say, hey, I'm willing to have a 5% loss on a particular idea. It's fine, but be in control of that. So when we're building our portfolios, we need to incorporate, most importantly, what does the financial plan say we can do? What is safe to do according to the financial plan? And then I do argue that while theory is problematic in terms of actually utilizing it, it is helpful as a guide. And I think using the passive index to begin your approach to investing is appropriate. And from there, you can say, I don't like this, and use your own intuition to appropriately manage your levers, but define your levers and track your levers. If you believe you have information, then you should be able to track that information. If you're not paying attention, then you might have underperformed or outperformed, and you would have no idea. So having levers, so instead of tracking 200 stocks, you can track 7 levers. And it's much easier to manage a portfolio and manage your information. And then you decide on how much you're willing to lose on any given trade. So that's how I would suggest someone who's getting into this practice slow down and think about what it is they believe in, what factors they want to follow, what data they want to understand, and distill that into how they would place that in a portfolio, place that concept.
Yeah, that's that's some pretty good stuff, and I do really agree with you that you know, you can't just buy random stuff and call it a portfolio.
True.
You
Very
really
true.
have, yeah, you really have to put risk at the heart of it, right? And especially since we're serving individuals, we really have to know their financial situation, right? Their financial plan. Which brings this question to mind. Since markets and client situations, circumstances are dynamic,
Mhm.
they move and change. How often do you suggest we update the financial plan?
Oh yeah, that's a great question. Certainly, whenever there is any change in the client situation, you have your quarterly reviews or annual reviews. If there's a change that needs to be addressed, then you put it in the financial plan. Once it's in your system, hopefully it's automatically tracked, and you don't build it and then it gets lost. So in my experience, it takes 10 or 15 minutes to update it. It doesn't really adjust that fast. I mean, there's very little. I mean, market movement doesn't change your outlook. And I think if the market fell 20%, a lot of times, well, the next year it's up 20%. So I wouldn't want to hyperventilate on making sure the client has the latest change. But certainly when a client if you have an annual meeting, you should probably have that updated just with the latest market values. Inflation is an issue, especially now. So you want to make sure that you had an understanding of how much they expect to spend, and there is an inflation adjustment in that process. Well, is their latest spending consistent with what you already have in the model? So certainly no less than annually, but I don't think any more than annually unless they have a specific question.
You mentioned about levers in constructing a portfolio. What parameters and rules should we be aware of? Not all members of RFC or IARFC Philippines are naturally into investments. Many of us are came from the life insurance industry, unlike my good friend here, Andre, who's really an investment guy. But most of us are practically relationship managers. So
Yeah.
If we were to advise clients in talking about these levers that you mentioned, what kind of rules and parameters should we put in when we construct an investment portfolio?
You have to be aware of what information you have. So if you're going to be using levers as a tactical or strategic opportunity to outperform, you have to be aware of what you can know. So most simple, let's say a stock, let's say an online stock reporting, or like Yahoo Finance, or I use Stock Rover. So you can use that, and it's very simple just to say, how have technology stocks done this year or last year or the last 3 years? And you're able to say, okay, it seems like it's underperformed relative to the rest of the index. I might feel that it's cheaper. So to the extent that you have information, that should be the limit of the lever you use. Otherwise, you're taking a blind risk. So when you don't have granularity. For example, if you're doing an insurance product, understand what those different products are offering. How is each product have a different risk than another product? What specifically are you vulnerable to if something goes wrong? Or how can things go well? So it's really, product dependent in what you're allowed to do, or what your different product options are. And what I just argue that understanding without knowing what your risk is, I'd be very careful about going too far in one direction or another. Again, starting with the financial plan, the most important thing you can do is decide how much you want in stocks versus bonds. It's the most important decision. At the end of the day, 20 years from now, it's not going to matter that much whether you're in value or growth. What matters is whether you were in stocks or not.
Thank you, Jesse. Andre?
Yeah, when Jesse was talking about the different products that we have access to, in my case, when I started out as a stockbroker, we don't exactly have products to push, right? But it just reminds me of something in my experience that there's some clients who are so eager, to just get started investing, and they just want to dive in, and then they start talking about picking this stock or that stock. How important it is, would you say, that to temper the client and first talk about how much risk the client can take, and how can we actually talk about this, or how can we actually put this the risk, the idea of risk or managing risk as part of the conversation with a client?
If you have a client who is making demands of you that you are not comfortable fulfilling, that's an important conversation topic. You need to be able to communicate that. So when you're like I will not disparage bottom-up investing, finding great stocks. I mean, if you are good at that, you should do it all day long. If you are good and feel comfortable, I think a lot of people feel a lot better about their skill than they actually are. And so I'd caution you to be very clear to yourself about what you can offer the client. And historically, we can accept that the stock market goes up, 8% a year. And if it doesn't over a long period of time, it'll probably get back to there. In any given year, we can't guarantee it. But certainly over time, we can expect the stock market to do well. I cannot say the same about an individual stock. So when you are starting to look for very active positions, very volatile positions, you no longer have the crutch of the market saving you. Now you're relying on very idiosyncratic, very volatile scenarios where you don't have the benefit of diversification. So if your clients are making a demand of you that you don't think you can fulfill, I think you should recognize that. If it is something you want to do, I don't want to discourage that. If you are comfortable with that, it's your client, and it's no one's position to say as long as you have their best interests, if you have the skill, I don't want to disparage that. I don't think most people have the skill they think they do. And I would not feel comfortable doing that. But you are entitled to your clients.
Yeah, good point.
Great point.
Yeah, and I agree. There are some people who are actually quite good at some parts. I've encountered some people who are really good at day trading. Surprisingly, wow, they can beat the market. But and for the most part, it's really important to talk about the risk side.
Here's the biggest caveat, I think, is that if you are market timing and saying now I'm going to be in the market, now I'm not, your neutral position is the financial plan. So if you're day trading, or you say, hey, now it looks good, now it doesn't, let's say you're out of the market and the market's up 10%, you've just impaired capital for your client. And so if you're not going to invest according to what you say you're doing, I think that's problematic. And for example, if you're promising market returns and you don't deliver market returns, that's a difficult conversation.
Yeah. Talking about returns, thank you for mentioning this. It made me think, like, how do we actually track a portfolio's performance?
Sure. Well, there are three things we need to think about. One is the actual return each quarter and saying, okay, I did well, let's see this quarter, and that's straightforward because it's given to you. But when you're thinking about risk in your portfolio and how you want to be managing the portfolio, one of the best feedback mechanisms we have is something called tracking error. Tracking error is simply the standard deviation of your return versus the index. And using tracking error, we can isolate what we think is happening. So if you say, hey, I really like the index and I don't want to deviate too far from it, and your tracking error is 5%, like every single month you're up or down 5% versus the index, even if you're kind of tracking on average, you still have a lot of deviation that you have to understand. So even outperformance, significant outperformance, can be a problem because it can also imply you have the potential for underperformance. So as we continually track our deviations from market returns, it's fine either way, but you have to understand why that tracking error occurred, why that deviation occurred. And that will keep you from allocating your portfolio, because we should be able to understand, because of our levers, we should be able to say, hey, I was overweight tech and it did well and I outperformed, and I have all these different positions on, all these different levers being applied. You should know how those levers are performing. And if all your levers give you a result, you think, hey, on average, I should be doing well, and you did badly, you need to understand why, because you have a risk that you do not understand. And that's what tracking error does. So that is part of your portfolio construction process or evaluation process to let you know that it's being maintained appropriately. More sophisticated investors who have access to very good risk models can plug their portfolio in and the benchmark in, and the models will tell them in advance what their anticipated tracking error is. And that is a part of portfolio construction you can use to gauge how much allocation you should put in any particular lever. Another thing we can do in portfolio management surveillance is something called return attribution. Return attribution is simply looking at your return of your sectors versus the index and deciding or analyzing, calculating how much your sector overweights look compared to the index and how much your sector underweights look compared to your index. And without looking at any single fund, ETF, stock, as long as you know your relative sector weights, you can understand what your performance looks like and evaluate whether those sector bets made sense and then, or did well. And then we can look at the individual securities within that sector and compare those securities returns versus the sector returns and say, wow, now I know that my security selection either increased or decreased my alpha. That requires a lot more data, a lot harder to put together. But if you have the information, or if you're looking at a fund that gives you a return attribution, you can understand what that means. I think more often we will be using you'll be a user of someone else's return attribution, but we should have a basic understanding of how to put together a back of the envelope return attribution. For example, if we know technology outperformed by 10%, my overweight to technology was 5%. Well, then we have 50 basis points of alpha from the technology sector. And if we put all of our different levers together, then we should be able to understand what happened to the portfolio. It should not be a surprise what your monthly, quarterly, annual return is. I mean, we have the numbers, but we should know where that's coming from. If we don't, then we don't have control of the portfolio, and it's basically just a mass with inertia. You know, we need to be able to say our decisions were good or bad, but hopefully we should be able to say what exactly our decisions were that impacted return results.
Yeah. Wow. You know, uh, in your time here with us, we learned so much. Wow. I think this
I didn't learn it overnight.
Yeah, that's right.
Thank
exactly.
you for sharing it with us.
I'm sure this episode has been an eye opener for many of our many of our members, RFC members, and talking about our members. This show is really about practice management, right? Like how they can apply it in their practices or how they can improve it. And you've already shared so much, but we'd like to ask you if you have some tips on how our RFCs can apply this in their practice. We don't have the kinds of software available in the States, right? Like, in 15 minutes you can change the financial plan, right? But we don't have that here. So, and we also don't have a lot of these portfolio monitoring software and the like. So maybe you have some tips on how they can just improve their practices or apply this in their practice.
I think the most important thing you can do is have the financial plan and have the dialogue with your clients. Be able to talk about what's happening so that when the market is soft, when it's down, nobody is scared, because emotional investing is the worst situation you can be in. If you are comfortable and your clients are comfortable, then everything is fine. You have to realize that generating alpha, beating the market, it's nice, it's important, it's relevant. At the end of the day, the client comfort and safety is the only thing that matters. And be comfortable with that. But I think if you don't have the baseline, if you're flying by the seat of your pants, if you haven't sit down and know what the risks are, you're finding exotic instruments and things that sound great. I mean, the fact is, we are in this business because we find it interesting. As a segue, or completely off topic, but when I was trading mortgage bonds, I had the agency mortgage bonds that were guaranteed by Fannie and Freddie Mac. And it got to be really boring to look at them because there wasn't that much that you could look at there. Eventually, I started buying non-agency securities because they were interesting. They were fun to look at. Fun doesn't really mean you're helping, you're doing well. And it's not that non-agency and non-covered instruments are always bad. It's just that you have to know what your risk is. For example, my index did not have non-agency securities. So when I'm buying something out of index, I'm introducing a risk that is not present. So my advice is, be aware of the risks you should be taking. And it's fine to take risks, but understand them.
Can't think of a better way to close that. So thank you so much, Jesse.
Thank you very much for having me.
Generous with your time. Kuya Ryan, do you have some announcements for our members?
For all of our members, please do invite your friends who haven't taken the RFC conversion course yet. We have a public course scheduled this coming June 2022. So the inclusive dates are June 6, 8, 10, 12, 13, 15, 17, 19, 20, and 22, and 24. So these are 12 days of solid financial consultation learning. So they are done every Mondays, Wednesdays, Fridays, and Saturdays. Course fee is now 35,000 inclusive of tax. So you don't have to worry about anything else. And also, we would like to announce the RFC refresher course for those who have recently renewed their membership and you think you need some form of relearning of what the RFC conversion course is. So these will be on July 4, 5, 6, and 7 at 8 a.m. to 12 noon. So the fee for the refresher course is just 13,000. So I would also like to remind everyone to renew their membership. You see, being a member of the IARFC has a lot of perks. First off, of course, when you renew your membership, you are part of the official roster of RFC members worldwide. And of course, you get to connect and network with the global community of RFCs through iarfc.org website. And you get free access to continuing education seminars and conferences. Well, the conferences would be not for free. And of course, the RFC Tuesday podcast. So you'll be in the loop. And you would know. And you would not know. Kumbaga, mas marami tayong matututunan. So for renewal information, please contact Ms. Arlene Baguyo at iarfcph@gmail.com or call her up at 0917-645-7846. So contact IARFC Philippines now for your membership renewal. Our podcast episodes are shown every second and fourth Tuesday of the month. That's why it's very important to follow us on Facebook. Episodes are pre-recorded and are broadcasted through Facebook Live. On behalf of our executive producer, Ms. Grace De Vera Escobar, this is the RFC Tuesday podcast saying,
It is better to be in the know than to be the last to know. Thanks so much.
All right.
for your time,
Thank you
Jess.
so much.
Stay
Have a good
safe.
evening.
Bye.
Night.
Good night.